So today I'm going to talk about one of my favorite topics. Let's build a financial model that you'll actually use. All too often we find budgets, you make a budget beginning of December, maybe in January, and that budget never sees the light of day. You put it into the top right-hand drawer of your desk, and maybe you dust it off the following December. We don't believe that's the right way to use a budget. We believe in operationalizing that budget so that you're revisiting that budget on a monthly basis, seeing how you did versus how you expected. So what is a budget and what's not a budget? Let's start there. I'll tell you what's not a budget is it's not a crystal ball. It's not a prediction of the future. It's not just a finance, it's an actual operations budget. I will tell you what it is. Decision-making tool. It's sort of like your guiding light, your North Star for the year, even for the month. It's a living document that you use. Should actually align with your priorities for the year. So, how to start a budget. Let's not recreate the wheel. You probably already have your accounting in place. You've got your chart of accounts. I would start with your chart of accounts that you have in your QuickBooks or your Xero, right? So that way you now have your chart of accounts. That's how you're going to organize the data. You have some historical perspective on how you're doing in each of the accounts. And I take a spreadsheet and put your chart of accounts just like it was coming out of QuickBooks, put in maybe 6 or 12 months worth of historical data. And that's starting point, number one. Number two, I like to focus on revenue. Now, I will also say, let's not worry about accrual accounting for a second. Focus on the cash side of revenue. So a couple ways to think about revenue. You can look at your existing pipeline. So maybe you've got contracts, you've got monthly recurring revenue pipeline. You look at your pipeline and you see some really solid deals coming in. So you can do some short-term data, and then you can extrapolate that out maybe for the second half of the year. Don't overcomplicate the revenue. There are times where, at least for the revenue, I'll take a look at volume and what my expectations of volume is. But again, that volume, it could be a function of, do you have the capacity? Do you have the team to actually take on that work? So sometimes it's a little bit of a circular reference between revenue and the people you have to actually perform that work. And if you're an e-commerce business, you're sort of relying on maybe TikTok ads and Instagram ads to bring people to your e-commerce site. So I understand that building a budget can be very frustrating, especially on the revenue side, because that's really where the budget starts. Now, beyond that, you've got step 3, which is your cost of goods sold. Your cost of goods sold, 2 types. One, it's going to be your selling inventory, so you have a sense of what your expected cost per widget that you're selling. On a more professional services side, or an agency type of business, you're thinking about the people you need or have, most likely, to actually perform that work to capture that revenue. But there's a direct linkage between the two. If you're going to take on 5 new contracts and you know on average you're going to need 10 employees to perform that work, you can already begin to bake that into your budget. So then when those contracts actually do hit, you can go to HR and start hiring. Now on the operating expenses side, that's where it tends to be a little bit less variable. I kind of like to think, I try to be a little more conservative with my operating expenses. I like to look at what my runway or run rate. So on the operating expenses, that tends to be a little bit sort of flatter. I personally, I'm a little more conservative. I like to look at, say, the last 3 months or last 6 months, and I try to keep my operating expenses as flat as possible, obviously outside of wage increases on an annual basis. But unless there are dynamic moves that you're anticipating in that year, your operating expenses should be pretty straightforward. Now, next step is operationalizing this budget. That's the tricky part. Whether you're in the accounting space or you're a small business owner, one of the challenges that we all have in financial planning analysis is how to approach budgeting the same way with that level of cadence and rigor that we're so accustomed to on the accounting side. On the accounting side and bookkeeping, we know that every month you get the data into QuickBooks or Xero, you do your adjusting journal entries, and you produce financial reports, and voila, you've closed the month. On the budget side, we tend to forget that the budget, the process around budget analysis, variance analysis, is just as important, and frankly, can be just as straightforward as it is with accounting. So one of the things that we like to do here at GrowthLab is having sort of two views of our budget. I know, two views, not one. One, we start with the operations call. The operations call at the beginning of the month, I like to take a look at, this is what we're thinking for the coming months. We may be pulling in a hire, we may be anticipating a capital expenditure, and I like to look at the beginning of the month as an opportunity to roll my forecast forward 12 months. Then, of course, in the middle of the month, you're having your accounting close call. And then at the end of the month, that's where you kind of look at, here's what I thought we were going to do. Here's what we ended up doing. Sometimes this is known as a variance analysis, but really it's about understanding why we didn't hit our budget, the why, and what can we do in the following month to get back on budget. For those of us that are maybe a little more sophisticated on the budgeting, we also like to have updated forecasts. And that tends to be keeping that budget, not the budget per se, but keeping the forecast fresh, so you're always having that 12-month outlook. Now, the interesting part is if you actually roll that forward 10, 11 months, by the time you hit November, you almost have your budget for the following year completed, because it should have been done in November and December. So that's how you take a budget and turn it into a monthly operating tool. Now, the other benefit is stress testing cash. What keeps us up at night as small business owners is, am I gonna be able to run payroll next week? Am I gonna have the cash? Is that customer, are they gonna close their doors? Are they gonna show up again next month, right? We're always worried about, are we gonna have enough cash to meet the operational cash flow needs of the business, one. And then two, are we gonna have enough in free cash flow to meet our debt servicing obligations? So before we close out, let's talk about some of the common budget mistakes that you should try to avoid. The first one is probably the most important one, which is don't over-process, over-detail the budget. Keep it simple. It should be a tool that you can quickly review. It's a tool that can help communicate expectations to your employees, to your team. And I would also say, don't ignore the cash flow piece of it, because budgets are really meant to ensure that you've got the cash to meet the operational needs and cash demands of the business. And so with that, check out our next video, because we talk about why most small business budgets actually fail and how to fix yours. So if you enjoyed this video, please feel free to subscribe, and don't forget, we have plenty of YouTube videos around financial planning and analysis. Take a look.